Have you ever been stuck because lenders ask for your income, W-2s, or too much paperwork? What if there was a loan where they don't care about your personal income, only whether your property can pay for itself? That's what DSCR loans do. And the best part? You can use them again and again. One, what is a DSCR loan? DSCR means Debt Service Coverage Ratio. It's a measure lenders use to see if a rental property can support its own debt. Instead of checking your personal income or W-2s, what they do is they look at whether the rental income from your property is enough to cover all of the debt payments. That means principal plus interest plus taxes plus insurance plus all the required obligations. If the rent, after expenses, is enough to cover those debt payments, then you qualify. 2. Unlimited loans. What that means. Here's the part one want you to understand. With DSCR-based financing, there's no fixed cap on how many properties you can own. Why? Because conventional loans rely heavily on your personal income, debt-to-income ratios, and how much off-balance sheet debt you already carry. So after you own a few, banks start saying no more. With DSCR, each property, if it passes the income or debt check, is treated more independently. So as long as each property can support its own loan, you can keep acquiring. 3. What you'll usually need. Now, to be fair, there are some things you need. You'll typically need around 20% down for a DSCR property loan. Good credit. The guidelines I saw say around 640 plus credit score. Proof of rental or mortgage history for the past year. Also, because lenders are taking more risk, less about your income, more about the property's performance, interest rates are sometimes slightly higher than conventional loans. 4. Why use DSCR? Here are some benefits that make DSCR super appealing. No need for W-2s or relying heavily on your job income. Faster approval processes, less red tape. Ability to get cash out refinance based on the rental income. As you acquire more properties, your income limits and personal debt ratios matter less. The properties speak for themselves. 5. When it might not be best. It's not always the perfect choice. If your interest rate is significantly higher than what you can get with a conventional loan, and you don't need to stretch your borrowing capacity, the conventional loan might save you money. If the rental market is soft or vacancy is high, income projections could be risky. DSCR doesn't magically fix every risk. You still need good property selection, good management, and realistic rent forecasts. So there you have it. DSCR loans let you scale your real estate portfolio without being throttled by your personal income. No fixed limit on how many properties you can hold, as long as each one cash flows. If you want help figuring out whether DSCR is right for your next property, or if you want to compare DSCR versus conventional, let's talk. Whether you're moving in 9 days or 90, call me. I'm here to help you buy or sell a home, get the right mortgage, or fund your next flip or construction project. Click the link in the description to schedule a Zoom call with me today, and let's make it happen.